A corporation owes $54 billion. It's a debt load larger than the GDP of entire nations, and it defies standard economic gravity. This chart shows a company's financial health effectively inverted. The towering column on the right is $54.89 billion in total debt. The line on the left, plunging completely below zero, represents a negative 4,268% debt-to-equity ratio. By standard accounting metrics, this corporation is technically insolvent. Yet, if you look at this new glowing line emerging from that negative chasm, you see a dividend payout that rises without fail. A company drowning in billions of debt paid shareholders over $7 a share last year and plans to pay even more this year. This balance sheet structure facilitates a cycle of capital extraction, while the company maintains a state of theoretical bankruptcy. To understand this mechanism, look at this comparative area graph of profit margins. The small circle represents the 15% margin from selling food. The massive circle dwarfing it is the 46% operating margin generated by franchise revenue. The original McDonald brothers built a thriving drive-in in San Bernardino, California. They engineered a kitchen process serving a 15-cent hamburger in 60 seconds. The scale of their efficiency was highly unusual for a post-war economy. A single desert location was churning through so many customers it required a massive bank of industrial multi-mixers operating constantly. When Ray Kroc bought the brothers out, his vice president of finance, Harry Sonnenborn, focused on the specific land where those restaurants sat. He shifted the corporate focus toward acquiring the highly trafficked intersections that defined the brand's physical footprint. Corporate buys the prime commercial land, signs the long-term leases, and then subleases that exact same dirt back to the franchisee at a 20 to 40%. The franchisee takes on the immense risk of running the daily restaurant operation, while the corporate entity safely collects the rent. The physical restaurant serves as an operational tool to ensure that the commercial rent is paid every single month. The hamburger is the reason the rent exists. Corporate control compounds through the supply chain. By purchasing over 700 million pounds of beef annually in the U.S. alone, they do not pay market prices. They dictate the cost of raw materials to regional processors, effectively setting the market rate, while leaving their franchisees to absorb any local inflation. They apply the exact same logic to their consumers. The mobile loyalty app, which processes tens of billions in sales, operates as a surveillance engine. It monitors behavioral data to implement dynamic pricing, offering different customers different prices for the exact same meal based on their purchase history. To protect these revenue streams, the corporate office in Chicago maintains a strict structural firewall. They employ roughly 150,000 people directly, completely separate from the 2 million workers operating the franchise locations. Corporate legally classifies these locations as independent businesses. The central architecture captures the financial upside from the land, the suppliers, and the customer data, while delegating the labor and liability to the franchisee. The priority of the corporate board is to protect this exact structure. When CEO Stephen Easterbrook was found engaging in inappropriate physical relationships with subordinates, the board deliberately classified his termination as without cause, allowing him to leave with roughly $44 million in unvested equity. Firing him for cause would have triggered a public legal battle. A lawsuit brings discovery, and discovery invites journalists and federal regulators to audit the internal communications of a company actively shielding a massive tax and debt apparatus. The board chose to pay millions to contain the problem. This identical containment strategy was used during the Monopoly game fraud. For 12 years, a network of organized criminals stole nearly every high-value prize. Corporate audits failed to flag that winning pieces were clustering among a tight group of associates, because the game itself was generating hundreds of millions in incremental sales every year. The corporate response mechanism is consistent. Management prioritizes the insulation of the financial architecture from any external scrutiny that might threaten the rent collection. Because corporate extracts such a high percentage of revenue in rent and royalties, local operators face intense mathematical pressure to find cheap labor. Federal investigations recently found over 300 minors working illegally across multiple states, including 10-year-old children operating deep fryers at 2 in the morning. The legal shield successfully absorbs those labor violations locally, but physical contamination is harder to isolate. When E. coli from a Colorado onion supplier spread across 14 states, the decentralized structure became a massive liability, forcing corporate to intervene with a $100 million emergency fund. Of that emergency capital, $35 million was deployed directly into local marketing. They purchased enough advertising inventory in the affected markets to effectively drown out the investigative journalism trying to track the outbreak. The system functioned as designed. The localized franchise structure absorbed the physical contamination and the public relations damage. The corporate office managed the narrative, and the underlying rent collection machine remained completely intact. This diagram illustrates the mechanism driving their balance sheet. The company borrows billions in debt specifically to buy back its own stock. Shrinking the share count artificially inflates earnings per share, which triggers executive bonuses. The executives then approve more borrowing, and the cycle repeats, growing heavier with each rotation. Looking at the center of this loop, you can see the cost of this engineering. That massive red weight represents $1.58 billion. That is the annual interest expense required to service the debt, and it must be paid regardless of how many burgers the franchisees sell. To generate the cash flow required to maintain this cycle, the company pushed menu price hikes of roughly 40% over 5 years. This arithmetic decision broke the core promise they had maintained for decades: affordable value. The data shows the immediate result. Their most loyal, working-class demographic looked at the higher prices, abandoned the drive-thru, and went to the grocery store instead. The physical traffic dropped. Management is now projecting thousands of new store openings just to replace the stagnant sales of their existing locations. They are running incredibly fast to stay in the exact same place. With $54 billion in debt, relying on a fractured consumer base, they have built a system that cannot afford a single mistake. Next time, we turn to a financial engine that doesn't bother with real estate or physical goods at all, a system that processes transactions at a fraction of a cent, charges merchants 3%, and perpetually skims capital from the global economy without any physical infrastructure. We are going to look at Visa.